The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome to the webinar hosted by the IRC Institute and the Investment Integration Project on a new report, Measuring Effectiveness, Roadmap to Assessing System-Level and SDG Investing. Our agenda for the webinar is as follows. We'll start with logistics and introductions, then we'll move to an in-depth review of the research. The IRC Institute will provide its perspective on the report, and then we'll take your questions. In terms of logistics, all of our attendees today are in listen-only mode, but we do want your questions. Throughout the presentation, if you have questions, use your control panel, the question box, to type in your question. We'll read those aloud following the presentation and respond. For your information, this session is being recorded and a replay will be posted on www.irrcinstitute.org by tomorrow. We do encourage you to share information about this report. You can find us on Twitter at IRC Research and at @tip_insights. If you have any technical or audio issues during the webinar, please contact GoToWebinar at 1-800-263-6317. In terms of speakers today, we have three. Our first speaker is Steve Leidenberg. He's the founder and CEO of the Investments Integration Project and is also a partner at Domini Social Investments. He's a recognized leader in the areas of social and environmental performance of corporations and has been working in the field since 1975. He was the founding director of the Initiative for Responsible Investment and has published widely on responsible investment topics over the years. Our next speaker will be William Burkhart. Bill is the president and COO of TIP. He is also the founder of Burkhart Consulting, an impact investing advisory firm. Bill's been at the forefront of the impact investing industry and has contributed to the field of groundbreaking research, including a leading multi-year field building effort focused on the financial services industry in collaboration with the Money Management Institute. Bill is a visiting scholar at the U.S. Federal Reserve, serves on the Global Advisory Council of Cornerstone Capital Group, and is a founder of Impact Economy. And then our third speaker today is John Lekumnik, and he has served as the executive director of the IRC Institute since its founding. With the board of directors, he's led the organization to become a leading source of objective academic and practitioner research on an array of investment issues. He has decades of experience as an institutional investor, including time as the investment advisor to the New York City pension funds. John also is the author of a new book, What They Do With Your Money, How the Financial System Fails Us and How to Fix It, published by Yale University Press. Just a few words about the IRC Institute if you're not familiar with it. It's a nonprofit that was established in 2005. And basically what the Institute does is it funds and disseminates objective and unbiased research on a range of issues at the intersection of corporate responsibility and the informational needs of investors. Again, it's both academic and practitioner research. We have a research award each year, and there are two $10,000 prizes for that. Find information about that on our website. You can also find on the website more than 70 research reports, all of which are available at no charge. And with that, I will turn the presentation over to Bill, and he will run through a little bit of information about TIP and dive into the research. Bill?
Yeah, thanks, Kelly, and thanks for everyone joining us during your lunch break for what is hopefully going to be a very meaty conversation. So just to jump in with a little bit about TIP, we're a research services firm that provide guidance to investors on system-level issues. Just as modern portfolio theory extended analysis of individual stocks to a basket of stocks, TIP helps investors to move their level of analysis beyond just portfolios to include the context in which their portfolios exist. We do this through cutting-edge research, bespoke advisory services, and a subscriber-based resource portal and database. Our mission is to help institutional investors understand the feedback loops between their investments and the planet's overarching systems that make profitable investment opportunities possible. This is important because failure to do so will lead to dramatic disruption, say financial crisis of 2008, and steady or even dramatic degradation, such as from climate change and inequality, all of which will make make it impossible for investors to earn the returns necessary to meet the expectations of their beneficiaries and clients. Next slide. All of which brings us to today's discussion about our new report that is the focus of this webinar, which was developed over the course of the past 8 months and provides investors with a breakthrough roadmap for measuring the effectiveness of systems-level investing strategies, including measuring progress toward achieving the United Nations Sustainable Development Goals, or SDGs. The findings are based on extensive desk research, targeted interviews with 15 investment thought and practice leaders, and TIP and IRRC Institute's own industry knowledge and expertise. Next slide. All of which brings us to the big idea here. So central to the findings of this report is that investors can now measure whether individual organizations are using investing strategies in ways that can lead to influence on the health of the overarching environmental, societal, and financial systems upon which investors rely for wealth generation. This is the big focus of the report, attempting to determine how ultimately sufficient leverage can be achieved to exercise influence within today's complex, global, interconnected systems, and ultimately how the effectiveness of this influence can be measured. The thresholds of investor activity you see here is where we are headed. So this is the end game. What we found was that achieving influence at this broader level will generally require the individual actions by a diverse set of members of the investment community that will have a cumulative effect on the system level. If only a few asset owners and asset managers, even the largest ones in the world, focus on and measure the system level effects of their investments, we may get incremental change, but not the critical magnitudes of investor action needed to actually shift paradigms. So to get to this part, the whole big paradigm shifting point, though, requires investors to take a number of steps, which we'll unpack now. Next slide. So just as a kind of high-level cook's tour of the report, we detail these steps that investors need to take and show how investors can measure their potential for influencing shifts in paradigms. They can do this by establishing the legitimacy for their concerns, creating cultural change among their peers, and using the full weight of activities they have collaboratively created as an input into the system in question. This is how ultimately investors can fortify returns over the long run. To prove their effectiveness, investors are building on existing impact measurement practices through new additional efforts. They are continuing to gauge quantifiable direct incremental change caused by an investor's individual market transactions, what we would call portfolio level activities. These efforts in turn create the crucial building blocks to determining the alignment of impact with broader goals and ultimately to assessing investor influence on systems. As I mentioned, investors operating in this way can influence the key characteristics of systems, their adaptability, clarity, connectivity, and directionality that helps ensure their resiliency. Next slide. This new research builds on a previous body of work by the IRRC Institute and TIP that introduced the tools of intentionality. Some of these tools and their related underlying activities are a natural extension of modern portfolio activities and are going to be easily recognizable to many investors. Others reflect approaches not typically incorporated into day-to-day portfolio management, but each represents a way that investors attempt to influence the environment, society, and financial system through both portfolio and non-portfolio related strategies. That is, through strategies directly related to the management of their investments and through additional strategies implemented above and beyond portfolio management. For example, things like public policy advocacy, thought leadership, and convening of investor interest groups. Next slide. This all brings us to our first big key finding, which is that investors need to assess system-level issues appropriate for their consideration, and they also need to establish commensurate influence goals against which to measure progress. Next slide. This step is important because the potential range of challenges that investors might address is incredibly substantial, and not all of these considerations can be justified as system level in their scope. So investors need criteria against which to assess potential considerations. So for example, I might think gender diversity is the key to global stability, and you might think that a healthy climate is. In either case, we need a way to justify these considerations. System level issues worthy of or that justify investor consideration and attention conform to 4 criteria: consensus, relevance, effectiveness, and uncertainty, which you can see broadly laid out here. These 4 criteria help to determine if there exists sufficient rationale for investors to focus on the system. They then assist investors in assessing the relative importance among issues to which time and resources might be devoted. So let's take climate change, for instance. In terms of consensus, the International Panel on Climate Change, the IPCC, which is an authoritative source of scientific opinion on the significance of climate change, documents in its 5th assessment report the consensus within the global scientific community that climate change is underway, is caused by human activities, and causes disruptive system-level risks. For relevance, left unaddressed, climate change can cause economic harm worldwide, likely to affect investors' portfolios across all asset classes. Investors globally have formed coalitions such as the Climate Action 100+ to address and contend with these risks. For effectiveness, investors, along with corporations, governments, and civil society organizations, can take effective action to contribute to adaptation and mitigation that will lessen the risks of climate change. Calls for $1 trillion or more in annual investments in clean technologies in order to keep global temperature rises under 2 degrees Celsius have emphasized the importance of institutional investors' contributions. Finally, uncertainty. The greater the likelihood of system-level disruptions in the climate, the greater the uncertainties about climate change's potential impacts on the economy and all investors. Use of scenarios, such as those suggested by the Task Force on Climate-Related Financial Disclosures, represents one means of reducing somewhat the necessary intractable uncertainties involved. So no, meeting these 4 criteria is definitely a high bar. And one implication of applying this discipline is that only a limited number of system level considerations will be appropriate for investors at any given time. Next slide. So once investors determine which issues justify their consideration, they then set goals for the influence they intend to have on the issues identified. In doing so, investors can establish specific benchmarks against which to measure their progress. In the report, we describe a process for how investors can measure their influence on 4 foundational characteristics of systems, which I referenced before, that serve as essentially the core indicators of health and resilience, or lack thereof, of a system. So the first, adaptability. This is the ability of a system to adjust to shocks and major disruptions. For clarity, this is the coherence, flow, access to, and transparency of information about and within a system. Number 3 is connectivity. The value of a good or service is determined in part by how many people use it, and the more it is used, the greater the benefit to the system. And finally, directionality. So these are the market incentives structured to encourage positive changes in stakeholder behavior. In general, progress indicators for various goals have already been widely discussed and agreed upon. It is the setting of goals and progress indicators for system characteristics like these that is less fully developed. So this goal setting exercise can also draw on work that has been done in recent years on the development of impact and sustainability indicators and their measurement. The development of these indicators calls for initial establishment of achievable, measurable goals reflective of capacity constraints and stakeholder input. So these goals should include defining the boundaries of the system and issue that the investor is targeting, identifying the timescale for the change sought, and specifying the desired change in the quality or characteristic of the system in question. Next slide. So this, of course, now brings us to the big second key finding, which is related to measuring effectiveness. So assessing the potential usefulness of the tools available to investors for creating influence and assessing whether implementation of selected tools is effective. Next slide. So as a quick recap, at this point in the process, investors have determined and justified which issues to integrate into their strategies and establish corresponding goals. Now they need to determine how best to measure the effectiveness of these tools towards achieving those goals. This is where the tools of intentionality I mentioned earlier come into play. Some of these tools derive from investment decision-making and daily portfolio management actions. Others reflect ways in which investors can exert influence outside of or beyond daily investment and portfolio management techniques. These tools can be roughly grouped according to three broad tactics. The first is field building, the second is investment enhancement, and the third is opportunity generation. For example, investors use opportunity generation tools such as additionality, locality, evaluations, and utility to enhance the richness of the pools of capital within a system. Investors can address disparities of opportunity amongst stakeholders within a system, locally as well as globally. They can incorporate into decision-making the difficult to qualify overall value of these systems and use the distinct natural function of each investment class to enhance that value, all of which furthers long-term viability. An opportunity generation tool additionality is well suited to enhance the adaptability of the system by facilitating investors in recognizing the market potential of underserved regions and segments of the population, promoting climate change, for example, markets and opportunities that fill gaps in the marketplace, and understanding how these markets and opportunities have the potential to produce competitive returns. So let's take an example. Multilateral development banks, including the African Development Bank, Asian Development Bank, European Bank for Reconstruction and Development, IADB, and World Bank Group, support the 8.3 billion climate investment funds, which include a clean technology fund and a scaling up renewable energy in low-income countries program that are dedicated to helping low carbon emissions energy programs and climate resilient infrastructures in 72 developing countries. Another example is Bridges Fund Management's mission to serve underserved communities, including making investments to improve the environmental sustainability of and decrease carbon emissions from buildings in the UK and the US. Next slide. Investors or evaluators also need to measure whether individually these organizations are using the tools of intentionality in ways that can lead to collaborative action and influence. Sure, initiatives by institutional investors can, under the right circumstances, have influence at system level, but more typically it is through the actions of a diverse set of members of the investment community that sufficient leverage can be achieved to exercise influence within today's systems. So for example, for a field building tool like Polity, such efforts might be assessed by looking to see if the investor has led efforts that encourage government to establish policy that facilitates increased or improved investments in solutions to income inequality, for example, or that discourages investments that perpetuate resource inefficiency. Or for an opportunity generation tool like Utility, you might look for indications of investments in venture capital and private equity investments with a renewable energy focus. Next slide. The third and final step is to actually measure influence. That is, investors need to measure changes in system adaptability, clarity, connectivity, and directionality, paradigm shifts that promote system health and resilience. Quick progress check. At this point in the process, a sufficient number of investors individually have determined goals for their system level investing approaches. They have also put the tools of intentionality into action toward achieving those goals. It is now possible for investors themselves or their evaluators to establish when critical thresholds have been reached in creating the potential for influence. Next slide. Towards that end, the report identifies 3 levels of influence by investors. At around 10% of involvement by the world's largest investors, recognition about the legitimacy for considering issues will get the attention of all necessary stakeholders. At the next one, the 1/3 threshold, a cultural change will start to occur in the financial community, creating positive spillover effects on corporations, government bodies, and NGOs. But it will take this kind of centerpiece the 2/3 of the world's largest investors of all types across all assets before positive system level benefits will be achieved. In the context of climate change, we can point to a few examples of such shifts apparently in action. So when it comes to adaptability, a recent report by Ceres and the Clean Energy Venture Group indicates that a shift toward increased investment opportunities in clean technologies, including renewable energy, may be underway. When it comes to clarity, as I mentioned earlier, there's been this uptake by corporations, financial institutions, and investors on the recommendations of the Task Force for Climate-Related Financial Disclosures, which indicates that the availability of such data is becoming broadly recognized as a baseline standard in the investment and corporate communities. With connectivity, investors with trillions of dollars of assets under management coordinate climate-related engagements with corporations and policymakers through the Interfaith Center on Corporate Responsibility and the PRI collaborative platform. They are also members of the recently launched Climate Action 200+ initiative. Finally, for directionality, in 2015, governments from around the world met in Paris at the UN's 21st Framework Convention on Climate Change and agreed to announce their intended nationally determined contributions to greenhouse gas emission reductions. Next slide. Measuring this kind of influence also builds on a few other inputs, including progress indicators. So system level progress indicators are by design quantitatively measurable, although some are more difficult to measure than others, and others are measured relative to goals. Paradigm shifts and characteristics are qualitative and are measured in terms that compare the differing characteristics of two contrasting systems. The difference between progress indicators and characteristics can be illustrated by comparing the targets and indicators of progress toward those targets that the UN has established as part of the metrics relating to the SDGs, which is what you can see here. This framework identifies 244 indicators that relate to the 115 targets associated with the 17 SDGs. So for example, goal number 1 on your left is focused on end poverty in all its forms everywhere. A related target is by 2030, eradicate extreme poverty for all people everywhere, currently measured as people living on less than $1.25 a day. A corresponding indicator is proportion in population below the international poverty line by sex, age, employment status, and geographical location of the corresponding. As you can probably tell, the indicators are quantifiable and measurable outputs that can indicate progress or lack of it toward the aspirational targets and goals of the SDGs. The 17 SDGs are system level goals, and to achieve them require paradigm shifts in system characteristics. Next slide. Influence also builds on measuring alignment. Some investors have attempted to go beyond measuring the system level impacts of their investments and portfolios to determine the extent to which their investments and portfolios align with broader system level goals, such as the SDGs. This important next step beyond impact measurement helps investors to understand their individual direct contribution to system goals. But crucially, it also ensures that they are more effectively deploying capital towards objective, commonly agreed upon global priorities, as opposed to subjective, isolated ends that might ultimately work at cross purposes with the rest of the investment community. For example, a consortium of Dutch financial institutions and policymakers, led by pension fund managers PGGM and APG, provides investors with guidance, including specific impact indicators by goal, which you can see here, for measuring the alignment of their assets with the SDGs that builds on the GIN, the Global Impact Investing Network's IRIS framework. The consortium suggests that investors map or crosswalk the GIN's IRIS indicators, and specifically the project impact and operational impact indicators, to the UN's SDG Compass indicators. Next slide. Influence finally also builds on measuring impact. While the report that is the focus of this particular webinar focuses on the assessment of system level influence, the importance of continued portfolio level impact measurement cannot be overstated. Gauging quantifiable direct incremental change caused by an investor's individual market transactions is a crucial building block to determining the alignment of impact with broader system level goals and ultimately to assessing investor influence on systems. As we work our way around this wheel, these approaches may include, at a high level, setting goals using a logic model or theory of change, developing a measurement framework that specifies data collection and analysis approaches, and utilizes existing metrics and aligns with existing standards to the extent possible, collecting and storing data using available technologies, validating data, analyzing data, reporting impact information to stakeholders to inform decision-making, and finally, making data-driven decisions. Next slide. To sum it all up, what investors can reasonably measure and monitor is their progress in increasing their potential for influencing the overall characteristics and progress indicators in relation to systems level challenges. The difference between measurement of the impact of holdings in a portfolio and the measurement of the potential influence of investors' overall policies and practices at a system level is coming into view. The former may be aligned with the goals of the SDGs, say eradicating poverty, but typically does not measure its impact relative to a system level progress indicator, say percentage of the population still below the poverty level. Instead, it reports on what its portfolio alignment is with the goal, for instance, number of jobs created for the homeless. What our research shows is that investors committing their firms as a whole through a variety of policies and practices and working in collaboration with like-minded investors can measure their potential for influencing shifts in systems paradigms, say toward a system that generates no extreme poverty in a number of ways. They can establish legitimacy for their concerns, create cultural change among their peers, and use the full weight of the field building, investment enhancement, and opportunity generation activities they have collaboratively created as an input into the system in question. To be sure, much work still needs to be done. System level reporting, data sources for metrics and indicators, and a better understanding of correlation are just a few areas that need to be better charted. What is clear though, is that measuring the effectiveness of system level and SDG investing is possible, is the foundation upon which investors can base consistent system impact over time and protect the ability of their funds to generate returns in the long term. To quote the business management pioneer Peter Drucker, what gets measured gets managed. Investors can effectively manage the wealth creating potential of the world's systems. They simply need to measure their influence on them. Thank you. To continue the discussion, I turn this over now to John LaComa to offer the IRRC perspective on this body of work. John?
Thank you, Bill. I normally refer directly to the report, but I'd like to provide some context for the report. I just spent an extraordinary week in London launching a different paper, but one which is incredibly complementary to this one, discussing systemic risk on institutional investor and asset owner portfolios. And why is that important? And in fact, discussed how practitioners are ahead of the academic theory. The academic theory basically says that investments are atomistic. In other words, we get buffeted by systemic risk, the risk and return of the marketplace, what professionals call beta, but our investments do not affect beta. And yet, at the same time, and so beta is in effect exogenous to our investments. But the purpose of asset management are multiple, intermediation and a bunch of other things, but it's also to create a desirable risk return characteristic in our investments. And that is not just the risk that we can control through trading. Indeed, all the academic literature says the risk of beta, the effect of beta on your returns is 9, 10, 11 times more powerful than anything that can be achieved through trading. And yet, the current state of investing is there are three major types of investing. There's traditional active management to beat a relative return benchmark. Is given, and there's smart or factor, which sort of says there are parts of beta we can decompose, but we're going to accept that as given. What the tip paper shows is how we can affect the systemic risks that create that beta, how we can measure our alignment with trying to improve the condition of the systems to mitigate that systemic risk, and how we can measure our influence to reduce that risk. Those are really worthwhile goals. Asset management by 2020 will be $111 trillion business globally. If we can get 0.1% improvement in that risk return ratio, our world will be wealthier, and we will go a long way towards improving standards of living and poverty and a bunch of other things. The classic systemic risk here that people have talked about is climate change for obvious reasons. And I want to point out that this has been done. Back in the 80s, CalPERS changed how the Philippines dealt with cross-border investments. That's traditionally considered political risk, something that's exogenous. New York City has led a campaign on proxy access to change how people get on boards of directors. State Street has led a gender diversity initiative to change the number of women on, as have lots of others, but State Street most recently on how women get on board to create, and so these create a more robust financial system through improving governance. And most notably, the Paris Accord featured a huge coalition of institutional investors and institutional asset owners to try to deal with climate change. But these have been seen as one-offs. Someone was dealing with an unfair law in the Philippines. Someone was dealing with an unfair governance situation. Someone was dealing with climate change. And really what these are, and one of the imports of the paper, is these are attempts to deal with systemic risk issues. The paper identifies them as environmental, social, and financial systems risks. And that systems level investing just has a huge potential to improve risk returns. As Bill said, this is not getting rid of modern portfolio theory. It is evolving modern portfolio theory to add a third level to it. There's always been security selection and portfolio management, and now what we're talking about is how do we mitigate systems level risks. Next slide, please, Kelly. So it is very much, this report is a roadmap to how does one do that. And as Bill said, it's assess what's appropriate. I would add to Bill's 4, the idea of fiduciary responsibility. That's usually a good lens to look at this with. It also curtails the number of possible issues that fall into appropriate action, in this case by thinking about how they affect your beneficiaries and how they affect the systemic risk of the portfolio. How? It's an important part of the report, and it's given short shrift, as is everything in a short webinar. But the report's great about suggesting here are some effective tools. Let's match each with what's appropriate to use and how much. How do you measure influence? How do you get to a tipping point? Next slide, please. So system change in the end can generally be measured. We can tell you how many women are on boards of directors, how many companies have proxy access, to take some governance ones. Sometimes you can directly link them to efforts being done. Sometimes you can't. But the mere fact that you can't always deliberately have a calibration that's quantitative that leads to this is the result of Ceres coalition action, or this is the result of New York City's action, or this is the result of BlackRock or State Street or some other asset manager's action, or Bridges in terms of impact investing, does not necessarily mean that there aren't logical inferences of causation, that all those investors who have chosen to use these tools of intentionality, who have chosen to try to affect systemic risk, have created that 10%, 33%, 63% move towards a point where a tipping point occurs. It's very difficult to say what pushes something over the edge to the point where the system dynamic changes, but it is very clear that all these actions, in effect, provide the kindling to get you to the spark that creates the configuration that changes the system risk profile. And with that, we will be glad to entertain questions.
Terrific. We're on to the Q&A, excuse me, Q&A portion of the webinar. And as a reminder, if you have a question, what you can do is type it into the question box, and we will read the question aloud, and one of our speakers will respond. And it looks like we already have several in the queue, so I will just get started on those. The first question. In your research, did you uncover a leading way through which investors are aggregating their portfolios based on contexts? For example, is it by impact themes or sectors or geographies?
I'll start with that. It's sort of all three. The most obvious is impact theme. So you clearly have a series of aggregating entities, series around sustainability issues, for instance, in the United States, or the Climate Action 100 around climate change specifically. So those are examples of thematic initiatives, and there are others also in climate action, such as the 2-degree investing initiative, preventable surprises, etc. But there are also regional groups that get together. So, for example, in the UK, just in terms of stewardship and general responsible investing on a company-by-company basis, and I should say that sometimes even a company engagement can have systemic impacts if it does what former CalPERS CEO Dale Hansen calls "get the herd to run." In other words, if it sets a parameter of acceptability. So, for instance, in the UK, there's something called the Investor Forum, which aggregates individual asset owners and asset managers to engage with companies. So it really, I think if I had to put them in some sort of cardinal order, I would say thematic first, but there definitely are regional groups, and often those two coincide. So, for instance, around issues like governance and health of the financial system, in the United States, the Council of Institutional Investors would be an example, but there's a great overlap in terms of its focus internationally with something called the International Corporate Governance Network. So what is, I think, accepted in the question, and we shouldn't skip over, is the fact that investors are forming these networks to have critical mass to change the system. And the truth is that prior to the Council of Institutional Investors being formed some 30 years ago, none of those networks that I just mentioned existed. So this is in terms of evolution of the industry, a not brand new, but relatively new idea.
And I would say and I would also encourage, sometimes Steve accidentally mutes himself, so I'm going to give him a chance to weigh in here. But I would say that one other kind of layer, for sure, we see instances of exactly what John described, where investors are kind of getting organized around particular issues. So I think you mentioned the series Water Hub was a really good example of investors coming together, but there are other broader coalitions obviously at work. We did also see some of these interesting kind of looking at things that were tackling the issue, but looking at it from a more functional perspective, I guess maybe is the way to describe it, where it's very issue agnostic. So we saw things like some of the work that's going on at the Impact Management Project, where they are looking at various like norms and principles for kind of guiding the effective use of impact management and measurement across different investor groups and really issue agnostic. We saw things like the Dutch consortium I made mention of, where they have been looking at these kind of crosswalks between different indicator sets so that people can start to align these things in a much more systematic way. We saw certain investors like Sirona that is looking at different frameworks for measuring different levels of indicators within an issue area. So not just seeing the direct portfolio impact, but also kind of raising it to this broader level of context. There are groups like the Investment Leaders Group at the University of Cambridge. I think it's the Institute for Sustainability Leadership, where they've done some really interesting work, essentially taking that kind of idea of different levels of metrics, yet again, less issue specific. So they kind of look at the SDGs and they try to pack them together into various impact themes. But that they have been kind of putting out these ideas around there's base metrics, there's stretch metrics, there's ideal metrics. These all represent different levels of access to information and sophistication. So we were able to, through the course of the research, really draw from not just those that have been going deep in a specific issue area, but also those that are thinking about just the kind of the scaffolding that needs to be put up to really understand the value of these metrics and what they're telling you at different levels. So I'm going to pause there. I don't know if Steve had anything to add.
Just that you see overlaps also between the issues in the regions and the focuses of these. So I think the Climate Action 100 Plus is a good example of that, where you have three major coalitions, a North America-based one, a European-based one, and an Asian-based one on climate change, of coalitions of investors, or pre-existing coalitions of investors that have been regionally developed for climate change, coming together and then drawing on another, what I would say, collaborative action of the Task Force on Climate-Related Financial Disclosure to set global standards for disclosure on climate issues, and then so that coalition using the globally agreed upon standards, and then to take data from various places to identify the 100 largest emitters of greenhouse gases, greenhouse gases, to make something that's truly systemic. So you've got a global coalition of investors using a globally agreed upon standard of disclosure with globally identified data points. So interesting crossover between those different coalitions, I guess I'll call them.
Thank you. We have a couple questions about the PowerPoint slides. We will have a copy of these PowerPoint slides available hopefully later today, but certainly by tomorrow morning on the website, www.irrcinstitute.org, along with a replay of this session, an audio recording of it. Our next question: how does the investment manager of a mutual fund report on the indicators for each target? It would seem the indicators are quite country level specific.
Yeah, this is an interesting point. For the Sustainable Development Goals, there's a kind of discontinuity between managers working at a portfolio level and the Sustainable Development Goals, which are essentially national goals. The interesting point about the SDGs is that they are systems level. The national goals are really comprehensive in their nature, and in setting these goals at a national level, it's forcing investors to think more holistically about what they are doing, taking their implications of what they're doing at a portfolio level and thinking, setting that in the broader context. So, in order to report and to measure and report this at this other level, this is what what we're trying to suggest in this is that what you're doing is you are, as an investor, you are using the tools that you have at your disposal that go beyond just simply portfolio selection. How you take your initiatives and conceive of them as in a broader context, which will allow you to think of the relationship to your in the investment community, your relationship to the SDG operations, or which you invest, the relation of you to say civil society, and
Steve, you're breaking up. Are you moving?
We might have lost Steve.
Steve?
coming.
I think we have a systems problem.
Gone away?
Yeah,
No.
that's better, Steve.
All right, as I was saying, that by seeing how you relate to your peers, you relate to the broader community of those that you're investing in, whether it's corporations or government entities, to NGOs, civil society, and public policy issues, that your reporting has to get out to that level in order to get up to the systems level and in order to get to the SDG level.
Like we're having that audio problem come back. I'm going to mute someone and see if we can figure out what the cause is.
Yeah, perhaps if you're not talking, maybe just to mute it. Do we have another question, Kelly?
Yeah, we do. It looked like that might have been coming from you, John. So I've got your line muted for a second. Our next question, sorry for the technical difficulties. What role could a non-institutional investor have at influencing goal setting?
Yeah, so I think, I'll do a quick reply here, but obviously invite John or Steve to jump in. So when we are looking at a lot of the more effective strategies, one of the things that we often point to is that there is this kind of consensus building or collaborative action component to really meeting those critical thresholds of investor activity. In the context of smaller players or non-institutional players helping to inform either what a lot of the shape the strategies take, the nuances of them, and the way that they get measured. Yet again, we can point to some of these consortiums, we can point to some of these task forces where it does give the opportunity for non-institutional players to help inform the process in a way that they wouldn't otherwise potentially have the same kind of level or quality of seat at the table, essentially. Because we do, I think this was kind of the point that Steve was getting to, is that the more effective strategies that are engaged here, and what we saw across at least the investors that we looked at, and they really do have a very dynamic quality in terms of the participants that are engaging. So yet again, if you were to go back to something like the impact management process, where a number of different kinds of investors, both at the institutional level, but also kind of smaller scale, and even nonprofit organizations like Acumen and others, where they're all helping to inform how investors are beginning to consider these different issues, integrate them into their practices, and then ultimately manage them going forward. It's the same thing of if you look at the GIN and how they've now recently launched an institutional investor initiative that's a complement to a lot of the other activities that they already had underway with other kinds of investors, Tonic would be another good example, where these are interesting consortiums or industry bodies that are attempting to bring in not just the biggest of the big players. And we see that as really indicative of kind of more effectiveness in terms of these strategies, the more kind of well-shaped they are by those different types of perspectives. I'd invite Steve or John to add anything further to that.
I just unmuted John to see if we can get him.
No, why don't we go into the next question because we're running out of time.
Okay. Terrific. So our next question is, I was at a conference last week on impact investing and private equity, and I asked a key panel about measuring the benefits of impact screens to a portfolio's performance. And no one said they had measured it explicitly. Do you have any comments on that?
So what I think is interesting about this is where screening in general has been obviously something that has been very fundamental to ESG integration, particularly in the public markets. And I would actually be curious, Steve, would you like to respond to that one?
Well, if I understood the question correctly, this is the question that has been looked at in a variety of different contexts outside of the private equity world. That is to say, what benefits or costs are imposed by various screens, and in the specific context of the private equity world, I'm not aware of any systematic studies that are being done. Most of the studies have been done in the context of publicly traded equities and fixed income securities.
Terrific. I'll move on to the next question. We've got quite a few in the queue. I'll try to get through them quickly. Can you expand on the issue of target selection in determining the optimal portfolio company for a shareholder engagement on SDG issues? Are there criteria, for example, for shareholder makeup, board quality, transparency? How should investors decide between a small impact at a big company by market cap or influence on the initiative in question, or a significant impact at a small company? That was a long question. You got that, Bill?
So there was a few layers to that question.
Yeah.
Can you just give it to us one more time?
Yeah. Can you expand? I'll read one by one. Maybe you can take it. Can you expand on the issue of target selection in determining the optimal portfolio company for a shareholder engagement on SDG issues? So are there criteria, for example, on shareholder makeup, board quality, and transparency?
Let me comment on that in regard to the selection of companies and the approach to them. I think there are a couple of different philosophies. I think choosing a company that is an industry leader for an engagement makes a lot of sense. An industry leader will then set an example for the others in the industry if you have attained some kind of meaningful change there. Second selection, I think, is if you have a cohort of other investors, of additional investors, a sense of the breadth of concern among investors with which you approach a company. So that, I think, can make a meaningful difference and increase the chance of effective engagement. So both those, I think, are key considerations.
Great. I'll move on to the next question. Is the exclusive use of market relative benchmarks a roadblock to recognizing the benefits from mitigation of systems level risks and managing beta? You want me to read that one again?
John, I'm sure will have some thoughts on that. I think one of the key insights here of this question of systems level issues and as they relate to the performance of the whole market. Are you creating a rising tide, or inadvertently through best practices, situation in which there is risk to the whole market and everybody, and there is no, in effect, no place to hide if the market is collapsing due to some kind of systems level problem. So the question of the benchmark measurement against benchmark, as John points out, becomes a secondary issue if the issue is the performance of the benchmark itself. I think that's what various investors, large institutional investors, particularly the Japanese, the largest pension fund in the world, the GPIF, the Government Pension Investment Fund of Japan, has in mind as it is paying increasing attention to the passive portion of its portfolio and the benchmarks that it uses and the adjustment of those benchmarks so that those benchmarks incorporate large-scale systems-level issues such as climate change, diversity, and environment in general. So the management of the beta is, as John says, is as important as management against the beta.
Thanks so much, Steve. Our next question. Evolving modern portfolio theory suggests there is agreement on directionality of all of the quote-unquote one-off, which can be combined to move toward a greater good, but aren't good and beauty in the eye of the beholder.
Could I just one thing? Did you want to try, I think John might have actually had a reflection on that last question. Do we want to just try to see if you were able to unmute him?
I tried to unmute it and it was the back feed again.
Oh, gotcha. Okay, fair enough.
Let me give it one more shot. Let me see how it goes. No, he must be trying to dial back in, so we don't have John.
No, I'm Kelly. I'm here. I don't.
There we go.
I've been trying to answer the last three questions. But just on the beta question, the issue is that we lack really good measurements, and so it's really easy to measure relative return. The problem is that's an internal measurement to the industry. It neither measures how you've done in mitigating systemic risk, nor does it particularly help the investor on a purely financial basis. If the relative return benchmark, the S&P or an aggregate, whatever, is down 10 and you're down 8, the person does a really good job, but you're still 8% behind where you started. So it's not a great relative return benchmarks sort of accept, as we said, beta and systemic risk. The issue is that affecting systemic risk lifts all boats, which is great for individuals, great for savers, and great for society, but makes differentiating different asset management firms more difficult. Could you repeat this last question, Kelly, just quickly?
The evolving modern portfolio theory suggests there is agreement on
yes. That is why, yes, beauty is in the eye of the beholder. And that is why Steve and Bill gave their 4 indicia, and I suggested that at the end it comes down to fiduciary obligation, because there are legally defined standards for that, so that you do not have a particular controlling entity of either an asset owner or an asset manager going off and doing their, I'm only investing in companies whose logos are red, or I am not investing in any company whose name starts with the letter P, or some other, one could put in their particular political bête noirs or whatever. When you have those 4 indicia that Steve and Bill mentioned, and overlay that the legal obligation of fiduciary obligation, I believe that is an adequate control. In the end, the trustees of the institutional asset owner and the industry itself in terms of management need to coalesce around where the bounds are of legitimacy and appropriateness in this. But it's definitely a risk. Can it be misused? Sure. But I think the risks of not engaging around systemic risk are greater, and we can't afford to do that. And the reality is it's happening now. So what this paper does is provide a roadmap of how to do it better. And what the theory that I discussed was a unifying theory around the practice. The practice has evolved faster than the theory. And so if anything, the paper and the theory provide constraints on it because absent a holistic view, those one-offs can go in any direction.
Okay. Thank you. We'll go to the next question. We have about 10 questions in the queue, and I know it's the top of the hour. We'll just keep running through them. Thanks for a great report. My sense is that one of the biggest challenges to getting to where we need to go is the investor mindset, that most investors see themselves as takers of what markets offer them rather than makers of the markets they need. Current leaders in this area are driven as much by social responsibility as systems level thinking. Do you agree? And if so, what are your thoughts on how we might shift the mindset?
I'll take that one because I'll do it quickly. Yes, I agree. I think that is one reason why this report and the week I spent in London and the fact that there is a huge turnout for this webinar is important. I do think we are probably not yet at an inflection point around that, but we can see building appreciation of the ability of the industry to affect systemic risk.
Our next question, can you please say more about how you arrived at the tipping point percentages, 1/10, 1/3, 2/3, and in particular, the dynamic interactions between indirect influence and direct impact?
Yeah, the levels, 10%, 1/3, 2/3, are in a sense intuitive levels at which we can go through what are probably 3 stages that you get to for something that would change the culture or the paradigms under which the financial system is operating when it comes to systems level. A switch from change from, in effect, ignoring the system level implications to actually having that systems level thinking be part and parcel of one's daily operation, that you don't need to think about it. And the first level would be simply recognition of the importance of the issue. And at the 10% level, the 10% really represents a substantial voice of large actors that may not represent the consensus within the financial community, but are sufficiently large that they will be heard, and heard with in a way that needs to be taken seriously. The 1/3 level represents something that is then becomes enough of the financial community that there is a countervailing practice, not just a consideration and an acknowledgement of an actual practice that is permeating the community in a kind of way that may not be the dominant way, but is enough of a way that it becomes part of the culture, if it's nevertheless not dominant. And the 2/3 represent something that is a dominant practice within a community, and therefore is more or less the accepted practice, and is the way in which one, on the whole, given other factors, is likely to be thinking. So that's where those numbers come from. They represent, in effect, 3 stages.
And I would just say, just to piggyback on top of Steve's comments, we saw some of this percentages, not necessarily in the same way that we structured them here in the report, but in terms of investors that either around issue areas, so critical thresholds of interest and activity as it relates to, say, gender diversity or some other issue. We saw it also as part of very specific investor activities. So take an example like the KL Felicitas Foundation, private foundation established in 2000, has a vision for transforming the financial system. One of the kind of key aims of the foundation, which they have a lot of really great publicly information on their website that people can go and check out more, but one of the key goals is to shift 10% of the $4 trillion currently held by endowments, high net worth individuals, and foundations to impact investments. The goal being to influence a broader section of the investment market to follow suit. So you see these instances where we could pinpoint specific investor activity. Rolling it up, I think, builds off of what Steve just laid out in terms of where we came to on these other kind of thresholds more early. But they're based in some kind of sound reality based on a lot of the kind of leading edge folks that we looked at.
Thanks. Our next question, what role should the accounting profession play in recognizing and addressing these issues?
So I think that, I guess the really quick response there is that it already, I think that in the same way that SASB is trying to more directly address that at a kind of, company specific and really portfolio level perspective, it has a huge role to play. There's some interesting work being done by Bob Eccles and a few others. They just published something on Sloan management, where they started looking at a lot of SASB standards as they relate to the indicators associated with the SDGs. It's once again, it's all of these different dimensions. Oftentimes when Steve and I sit back and we think about all of the different kind of gray spaces on the map that need to be colored in for people to really appreciate how to navigate around systems level investment. All of these kind of key functional qualities of just general investment more broadly, such as accounting, are huge critical components that will need to be solved for if this is going to really have legs for the long term. But I think we can point to interesting stuff that True Value or Eccles and others are doing that are trying to, I think, make some crosswalks possible. I don't know if there's anything further that Jim or John or Steve might offer on that.
No, I'm concerned that we're running over. So why don't we take 2 more questions and then we will get back offline to whoever's questions we haven't answered.
Okay, terrific. Is there data available to apply this approach to passive index-based investing, say to a portfolio with impact-focused mutual funds or ETFs or SMAs?
I think what's going to emerge here is the creation of a variety of different passive indexes that can be used for passive investment that will reflect systems level thinking. So just for example, MSCI now has a substantial number of sustainability and CSR indexes, all with a different focus. And as those different kinds of indexes become available, then and investors start using them, then it will become more possible to think about their effect and effectiveness.
Absolutely, and not only that, but even just traditional indices. One of the points that Bill made in his presentation is that many of the tools of intentionality that Bill and Steve and Jessica have identified are not the traditional trading related tools. They're things like public policy. And so, in fact, you will see places like BlackRock, which has a huge indexed business, talking about long-term investing, or State Street, which is known for indexation, talking about gender diversity, or Vanguard, which is known for indexation, beefing up its engagement staff to deal with these issues. So one of the great breakthroughs that I think that systems level thought has and that this report has is that it is, yes, creating a low carbon index or a sustainable index is one methodology in terms of product creation, but there are other methodologies, other tools of intentionality that can be taken, even if you have just a traditional S&P 500 index fund as either a mutual fund, asset manager, or even an asset owner that owns it. Indeed, it may be more important for a theory that Jim Hawley and Andy Williams created back in about 20 years ago, that you are an universal owner, and the externalities of things like climate change are reintegrated back into your portfolio in a lot of ways. So I think what this report shows is that there are multiple tools, once you decide to align, that are usable both in terms of traditional investments such as buy, sell, different index creation techniques, and even if you just have a traditional plain vanilla index that's cap weighted, there are tools that can be used that enable you to have systems impact.
Yeah, and just one thing there too, just to specify, so yeah, Steve started to make reference to it, but one of the things that we point to in the report is MSCI actually has this, it's a subpart of it, but it's the ACWI Sustainable Impact Index, which actually relates back to the UN SDGs. So it doesn't, I mean, there's a whole lot to it, but point being is that there are some of these attempts to try to connect this more broadly with some of the more passive strategies that the question was relating to.
Terrific. Since we're running so over on time, we'll take one. We'll answer one more question. If you have a question that we haven't gotten to, we have captured that, and we will follow up with you and either email you the answer or send you our contact information, and we can you can talk by phone with either John, Steve, or Bill to get your question answered. So thank you for all these great questions, and we'll get to all of them. But here's the last one we'll take. In my research of systems change, I have learned that many people and organizations have different definitions of systems change. How would you define systems change?
Yeah, so I guess one quick thought there, and then I would invite Steve to really reflect on that. When we started thinking through, okay, so how do investors really do this? How can they start to apply a systems dynamic perspective to these types of themes, to this kind of change to their investment practices? We looked at a lot of what leading systems dynamic thinkers were suggesting. And so if you look at something like Danelle Meadows and Thinking in Systems, she actually identifies these leverage points. And these leverage points are kind of whether they're related to parameters of the system, norms of a system, but they essentially speak to different qualities of a system or different layers of a system that can be influenced. And those would be the areas that you could start to pinpoint, okay, well, what does actual change in a system look like? For the purposes of this research, we looked at it and we essentially started trying to cull them down into something that was much more manageable and understandable for investors and just relevant in terms of applying it to their investment frameworks. What we ultimately came out with was these four, what ultimately are systems characteristics as opposed to calling them leverage points. We think that when there's change within these particular characteristics, that's when we can start to see specific, real, true systems change that will be different. So in the report, we specifically applied the framework to climate action. The change that we're seeking there, we have a really interesting vignette in the report where we just talk about the need of kind of shifting our dependency on one source of energy to multiple sources. And that's the kind of change that would ultimately lead to something much more long-term viable. That system change is obviously going to be different depending on the issue that's being challenged. We have a project underway right now where we're looking at this in terms of income inequality. Obviously, that's going to be different. So at any rate, just to say that we did attempt to try to come up with a framework for thinking about this that was much more relevant, applicable to investors as at least our starting point. I'm going to pause there. Steve, anything that you'd want to reflect on here?
Just very briefly, since we're to be sensitive about time, systems operate on certain paradigms, and those paradigms, in a certain sense, dictate what the system will produce. So in order to produce systems level change, one has to address the paradigms, identifying what the paradigm is that has produced the kind of challenge that one is facing in a system is the first task, and understanding what an alternative paradigm is that will produce a different outcome is the goal.
John, did you have anything you wanted to add?
No, thank you very much.
Terrific. Okay, so just to wrap up, just a couple things. You can see here on your screen the contact information for John, Bill, and Steve. We will follow up with each of you whose questions did not get through and respond to those questions. In terms of this PowerPoint presentation and the webinar replay, both will be posted by tomorrow on www.irrcinstitute.org. So all of those will be available. So we thank all of you for your time and sticking with us past the 2 o'clock hour. And thank you for your attention and your interest. And we hope you have a nice afternoon. Thank you.